the central bank largely expected to hold rates steady. All attention will be on what the Fed signals for the rest of the year. Fed Chair Powell saying just 2 weeks ago that the latest economic data has, quote, clearly not given us greater confidence in inflation reaching that 2% goal. For more, we're joined by Willem Sels, HSBC Global Private Banking Global CIO. Willem, great to have you here with us this morning. What's your anticipation going into the conclusion, I should say, of today's two-day meeting?
Well, no cut today. I don't think anybody is looking for this anymore. But the only thing that you really, as an investor, need to figure out is whether you believe there will still be a rate cut this year at all. Because the market has now completely shifted from pricing in 7 cuts to just 1 cut in December. So as long as you think they're going to cut before that, it's going to be positive for markets. The Fed is already out with quite a lot, of caution. As you mentioned just before, Powell has signaled that they need more evidence, before they will cut. But that is already really in the market. So he would need to almost rule out a cut this year or insinuate hikes, which I think is very unlikely, for it to be negative for markets.
So, Willem, does that tell us that the market's repricing here of the Fed rate cut path, what exactly that's going to look like? Has that gone a bit too far at this point?
I think the pendulum has swung quite far. I think it is more difficult for yields to come down very quickly. But I do think they have achieved levels which are quite attractive to lock in. So we do continue to put our cash to work. We're seeing good investment flows from our clients on this, either in investment grade bonds or in structured products, which incorporate on top of that some option income, and obviously also equities, because let's keep in mind that the other side of the coin of this hot for longer is relatively strong for longer. Earnings are very well supported, and you see a lot of analysts upgrading earnings expectations.
And so the earnings expectations that we've heard thus far, it's really been this theme of where demand is still remaining strong. Where are you hearing from companies that there is weakness in demand or some deterioration in the resiliency of the consumer, and even on the business spending side?
It's relatively broad-based, I would say. So certainly I'm encouraged by the fact that a number of blue chip companies have entered into contracts with large cloud providers and so on to really underscore that AI is real. And clearly that is important, but also earnings momentum is broadening. So financials, industrials, and so on, are benefiting, from that broadening of demand because of that resilient growth. But what I'm seeing as well, and especially for you U.S. Listeners, important to underscore that earnings drift is actually also, supported in other areas around the world. So we think investors should broaden not just their sector exposure within the US, but also their geographic exposure.
So then, Willem, where more specifically are you seeing those opportunities? And then when you take a look at a day like today, when obviously there's a risk-off mode happening right now in the market, is that something that maybe you don't expect to continue here for the weeks to come?
So I think today is obviously a very special day, with the Fed, decision, and especially I think, more than the decision, the press conference and what, Powell sort of communicates in terms of any further change, in tone or maybe a retracement on his message. But I do think that in terms of the opportunities outside of the US, we see them, in Asia, and there we take a diversified approach. So China's economic growth probably going sideways, a cheap market, and you're seeing a little bit of an uptick there recently as maybe some people dip in their toes, but we continue to diversify there. We see good opportunities in India, in Indonesia, in South Korea, and in Japan. So a broad-based approach more and more, makes sense for investors in our view.
Just to bring this full circle, if we only see 1 rate cut this year in December as the market is pricing in, what does that hold for 2025 from your purview?
So, that means that, we need to, if we only see one rate cut, we do think that we will, then potentially see further rate cuts in 2025 as we, get some further progress on CPI. Some of the, sticky things in the CPI measure are backward looking. So we see a number of rate cuts, but that being said, it's harder to get gains on equities from a price earnings valuation multiple perspective. So you need to look for that earnings. Those earnings to drive the equity market. But as I said before, in an environment where that earnings potential is broadening, we see many of those opportunities. So we're not too worried. We do think that equities merit a continued overweight.
Willem, Sels, always great to get your insight. Thanks so much for hopping on and joining us here this morning. HSBC's Global Private Banking Chief Investment Officer. Thanks.